Classic investing used to mean buying diversified assets for long term compounding. Now, investing apps offer instruments whose payoff patterns look a lot like bets: short dated options, high leverage, and binary ish outcomes, that is, win big or lose fast. Research on retail options trading finds many retail traders lose on average due to overpaying for volatility, trading costs or spreads, and predictable option decay. At the same time, gambling products are adopting market language, odds, charts, pricing, contracts, and real time trading mechanics, making wagering feel like finance. A major recent development is the growth of event contracts, prediction markets where users trade outcomes on real world events, sports, economics, politics. These products look and behave like financial derivatives, even when the underlying is not a traditional financial asset. Robinhood, for example, explicitly markets prediction markets that let users turn your insights into trades, including sports related event contracts in some jurisdictions. Regulators are actively grappling with where trading ends and wagering begins. CFTC materials discuss how state gambling laws may apply to sports related event contracts. The boundary isn't just psychological anymore, it's institutional. Different regulatory regimes, securities versus commodities versus gambling, are colliding in the same user experience. Modern broker apps use digital engagement practices, push notifications, top movers, prompts, frictionless trading flows, and other design features that can encourage frequent action. SEC advisory materials explicitly warned that certain alerts paired with frequent notifications can create urgency or FOMO and may function like calls to action. International regulators have also examined gamification or nudges as DEPs and their potential to increase trading intensity. We used to distinguish gambling versus investing by what you bought. Now, you often have to distinguish them by what the app is trying to make you do: hold and compound, or click and react. Online communities and influencer driven narratives can turn positions into identity, such as "we are in this together" feeling, which resembles sports fandom, an emotion pattern that fits gambling better than investing. This doesn't mean communities are bad, but it changes decision making from expected value thinking to belonging and excitement. Finance research has long shown that some investors prefer lottery like stocks that are cheap, volatile, with small chances of huge payoff, a preference correlated with real world gambling propensity. So the blur isn't only new, what's new is that platforms and products make this behavior easier, faster, and more continuous. Since 2018, legal sports betting has expanded widely in the US, growing the total market and normalizing betting as mainstream entertainment. At the same time, both sportsbooks and trading platforms use similar retention tools: notifications, VIP rewards, logic, personalization. The business model rewards engagement, so design patterns converge. If you want a clean rule set, use these. Number one, time horizon. Is the plan measured in years, that is investing, or hours or days, more like gambling? Number two, edge. What's the repeatable advantage? Fees, information, discipline, or is it mainly hope? Number three, base rate. Is the expected return positive after costs for most participants? Many short term, high cost trades aren't. Number four, risk shape. Can you lose most, all quickly, leveraged or short dated bets, or is downside managed through diversification and position sizing? Number five, motivation. Are you buying cash flows, ownership, and compounding? Or buying adrenaline and a story? The bottom line is it's harder to tell gambling from investing today because the mechanics, the interfaces, and the culture are converging into one continuous trade for a thrill ecosystem. Regulators are openly studying these engagement designs, and research shows how certain retail trading behaviors resemble gambling preferences, especially when payoffs are lottery like and time horizons are short.